Welcome to the Ask Me How I Know podcast, the only podcast in the multifamily niche replicating what takes place outside the walls of a seminar. This is like the lobby, where honest, unscripted conversations take place and transformation happens. We'll talk about practical problem solving in the multifamily niche, as well as overcoming limiting beliefs. Thank you for joining us today, and now for our featured guest. Hey, welcome back to Ask Me How I Know, multifamily investment stories of struggle to success. And today we have this amazing opportunity to speak with David White and Erica Neal. And I met them at Rod Cleave's multifamily boot camp. And they're these people that have so much energy and knowledge, but they know how to communicate it without being absolutely dull and boring. And they have this powerful ability to help us out. So those of you that are trying to move ahead in your syndications, this is really important information for you because there are a variety of strategies available to us to utilize our resources, to utilize our money. And some of you have that money already stashed away, but it's not doing anything for you. And you're kind of going like, I don't know what to do with this. And some of you have these self-directed IRAs that you think you're using to the best, but you really don't know. And so what we're going to do today is, the problem is we may have some money and we're not using it the most effective way, or maybe we need to juice our money to like make little money babies out there. And so what we're going to do is we're going to have this great solution right now with David and Erica, and they're going to give us like, can we get the 10,000 foot overview? Because for a lot of people, and I'm sorry, let me back up. Have y'all heard of infinite banking? So if you're listening and you haven't heard of infinite banking, this is a strategy that they use. It's also a strategy used by many very successful, wealthy people who have passed that wealth down for generations. And that's what we want to do, right? We want to leave a lasting legacy on the world and for our families. So David, 10,000 foot?
Yeah, absolutely. Thank you, Julie. And just appreciate the compliments. It was a joy meeting you at the event. And I really enjoyed your energy and your excitement to, really just open yourself up to ideas to grow and also your willingness to help others. So thank you for having us on. Really just the infinite banking concept is, it's an addition to things that we're doing. It's not an either or, it's a yes and. It's really just works really well in concert with a lot of our real estate investing, cash flow investing, and it's a way to warehouse our dollars in a place that we can have guaranteed growth, liquidity, right, and have the privacy. It's another asset protection, a form of asset protection. Have that legacy piece as well, and it really just what I realize, and Eric and I realize, is that there's a savings dilemma that we need to overcome. And so, along with adding a scaling strategy to our investing, it also, takes care of a savings dilemma as well as adding legacy. So, Eric, I'll let you maybe touch on. I know you do a really great job of kind of just an overview of that savings dilemma and maybe some of your additions into what you think this strategy can do, and we'll highlight it a little bit more.
Absolutely. Thanks. So, Julie, thanks for having us on. I'm super excited. Amazing intro. So, we'll try to live up to all of those things. But, David, like you said, the savings dilemma is one of the biggest problems that face people, whether it be real estate or in the traditional, W-2 sector. Because if we look at where most people put their money, they will have it in something like a bank account, right? And usually they're wanting to do that because it's considered safe and liquid. But Julie, you mentioned this, it's not really getting any growth. So on the other end of the spectrum, a lot of people will put money in things like, real estate is a fantastic place to invest. A lot of people in the traditional sector will put it into like an IRA or a 401k or something to that effect. And their goal is they're wanting to get that long-term growth. Fantastic. The caveat is that if we have it in those types of investing accounts, they are not considered safe because they could potentially lose value, and they're also not liquid. So now if we want growth, then we have to sacrifice safety and liquidity. But if we want safety and liquidity, we have to sacrifice growth.
What are we going to do?
What are we going to do? Exactly. So bank accounts are really good for money. And I'll just say this, David, and David and I usually mention this pretty often, that there's no such thing as a bad tool. Let's just be honest. However, you, Julie, mentioned this perfectly, there are tools that are more efficient and effective than others. So we want to make sure we're not trying to cut a piece of wood in half with a hammer. Okay. Bank accounts are really good for money that we want to use within the next 0 to 18 months. Investments like real estate, 401ks, IRAs, things like that, that's usually for money that's going to be a 20 plus, if not more, year timeline. So we can save money on a 0 to 18 month basis or a 20 plus year basis. That's a really big gap. That's a massive gap. And so we just talked about this credit crisis. People need a way to save money on the interim, right? Where can we save money? And David, you listed this earlier. We want to get that growth, but we also want safety and liquidity. And oh yeah, I want to keep my money protected. I want to keep it private, being able to shield it if and when, God forbid, things happen to our personal life, or in our business life. And then and David and I both are huge advocates for tax-free growth, right? If you talk to any farmer, they're going to say, well, would you rather pay taxes on your seed or your harvest? What do you think they're going to say?
Seed.
The seed, exactly. Why am I going to let all my money grow and then tax it later? That makes no sense. So, yeah, the savings dilemma is one of those things where infinite banking can fit into that interim, right? The middle ground, and it helps us not have to choose, safety, liquidity, or growth. It gives us that happy medium of both.
Wow. So we get to live in both worlds very, very merrily. That's
Yeah.
powerful.
Absolutely. And I love what Warren Buffett, Granddaddy Buffett, he coins these policies, these specially designed cash policies as the vault, right? And, who knows how much money you put into your vault, right? Only you, right? So it has this safety and it has a privacy aspect. So when we also talk about real estate, we want to shield ourselves from, as much liability as possible. That's why we use LLCs, things like that. So this is another avenue of shielding your assets, and warehousing your dollars in a vault that has the guaranteed growth, has the safety, liquidity, right? Because you want to be able to access it for an opportunity, right? I've heard people talk about this as being an opportunity fund, which is really what it is, right? And so
Opportunity fund.
exactly. And
Yeah.
right, banking, if you think about what we're doing, infinite banking is banking on yourself, and banking is one of the most profitable businesses. So how do we take some of the key points of the banking strategies and put it into our own life, right? And get to where we're able to really have what I call the 4 key pillars of infinite banking. And one of them is lower taxes, because we're going to be able to use this money to take advantage of cost depreciation or cost segregation, depreciation. We're also going to be able to write off deductions on the loan amount that we're being charged internally in the policy. We're going to be able to increase our leverage because we're going to use our own money to bank on. So we're going to have the ability to increase leverage. And there's also a positive arbitrage aspect to this. Of course, as you dive in more into infinite banking, and maybe we get one-on-one with some people, we can go over this positive arbitrage strategy, because you're earning compounded interest while you're only paying simple annualized interest on your loan. So you're earning internally. And like Robert Kiyosaki, some of these other people talk about giving our dollar multiple jobs. You're able to take it, borrow against it out the policy and put it into another investment. So you're able to give $1 multiple jobs, right? So you increase leverage, so you lower taxes, increase leverage, you increase your control, because you have full control over these loan terms. You dictate the terms, not the bank or not who's loaning the money to you. It's your money, it's your collateralized loan that you're basically loaning against yourself. So you dictate the terms, right? And if you ask anybody, would you want more control over in your financial situation? They're going to say, absolutely, right? I want to be able to control, right? Most people just throw in money in the market, hope and pray it all works out, right? Another aspect is lower risk, because you're going to use an asset that's uncorrelated to any risk, any sort of volatile market. Meaning in 2009, when real estate was down, 401ks were down, these assets grew. So they were uncorrelated to any risk, right? If you're going to use this as a bank, the last thing I want to be told is that, hey, your money in your bank where you're warehousing dollars may lose value, right? So you want these 4 key pillars. So lower taxes, increase leverage, increase control, and lower risk. So it's a really great strategy overall, conceptually. And then, there is the legacy play as well.
Nice. I think that the whole positive arbitrage, it's like, can be very confusing. And so I would love, if we have time, that might be something, or that could be something where people can give you guys a call, because what you have to offer in the strategy is fantastic. You can see if it's a fit. And is there a book that you would recommend before we go down to back to earth for a moment?
Yeah. So there is a book it's a very easy read. It's very quick. It's called Live Your Life Insurance by Kim Butler. And she does an excellent job talking about strategies for wealth building. And David and I always talk about building wealth, building wealth, building wealth, because there is a difference. I mean, most of our society today is focused on rate of return. Yes, rate of return is a good thing, but if it's the only thing we're focusing on, that's the only thing we're going to be getting. We want to take a look at our overall financial picture and make sure that what we're doing is building our wealth right now, in the short term, in the intermediate term, and then also in the long term, right? Because at some point, we're going to go from this accumulation phase of saving and growing our money, and we're going to want to enter the distribution phase, meaning we want to start living off of our assets as full-time income without having to get up and go to work every day. So we want to so we want to have our toolbox. We talk about having the right tool for the job. We want to make sure that we have a hammer, a saw, and a screwdriver, all different tools doing all different jobs. And if we focus on just one thing, then we're just going to be walking around with a hammer. And not that it's a bad tool, but it's not the only thing that we need, right?
Absolutely.
That's true. I
Yeah,
think we're going to grow trees also. We'll have a hammer saw, and then you're growing the trees so that you can make your own money, basically.
Yes. Well, I love what you said earlier. You talked about like having our money make little money babies. That is hilarious. I've never heard that, but it's clever. That's awesome.
My
Erica's
husband and
that now.
I talk about that all the time. We talk about like you want your what was that book? The Richest Man in Babylon.
Okay.
Have you guys read? If you
Yeah,
haven't read it, it's a fantastic read, and I even read it to my students because
Yeah.
they have a kids version, and it's a very old story, but it talks about this concept. And it doesn't say money babies, but that's how my husband and I ended up talking to each other, like, let's go make money babies.
Yeah. And it translates well to kiddos because you think about continuing that legacy. Yeah, absolutely. I did
yeah.
want to real quick, Julie, because you asked about like the internal arbitrage, and you're right. This is one of the most appealing pieces of the infinite banking world, especially for people in real estate. David, you said this perfectly earlier that this is not an either or scenario, right? Like we would never look at a business owner, entrepreneur, real estate investor saying, hey, give us your money instead of going to invest in real estate, right? Like they're going to laugh in our face.
Right.
And that's okay. I get it. So what we're looking at and what infinite banking is designed to do is to, number one, help people warehouse dollars in a way that they're getting more growth than what they're getting in the bank, and provide it in a way that it's safe and liquid. And so with that though, whenever they have an opportunity come up, they want to be able to go invest in that. They take their money and they go put it in whatever deal that they're getting. But let's say somebody has, $200,000 in their account and they want to go take, I don't know, 50 and go put it in XYZ multifamily deal.
Mm-hmm.
Well, most accounts, IRAs, 401ks, any other account out there, your savings is now only earning interest at the 150 you have left, right?
Right.
And the 50's out there earning. What infinite banking allows you to do is do what Robert Kiyosaki says and give the same dollar multiple jobs, put it to work in two places. So infinite banking allows you to take 50, go invest it in this multifamily deal through a loan, and internally, your account is still earning interest at the full 200,000 account value.
Wow.
So you can use your money and earn interest on it at the same time. Why not, right?
It's everyone doing this.
Yes, well, they don't know what they don't know. And you said that perfectly earlier, right? We just need to take a step back and look at all of our options and figure out what makes sense and what tool do we need to use for what job.
You ask if everybody's using it. Not everybody, but there are a lot of people using it. A lot of people that have money that know how to use different types of assets for different types of strategies. This is just another tool for them, right? And just a quick highlight on the positive arbitrage: you're basically borrowing against your money, and you're earning more compounding than what you're paying to borrow. So your money is outside earning a return in some sort of investment, plus it's earning an internal rate of return because it's growing faster and earning more than what you're paying down, because you're earning compounded, but you're paying down simple annualized interest. So you have this 3-4% internal arbitrage, while that same dollar is now earning maybe 10% in a cash on cash multifamily investment. So now instead of just 10 through cash investment, you're earning 13 and a half, 14 total on the investment. So it's a way to supercharge and increase your savings. And there are a lot of wealthy people who have scaled up in multifamily or commercial real estate in general that are using this strategy, that have multiple policies because they see the benefit of it.
Wow. Well, and once you understand that, understand how to use it, it seems like the sky is the limit. But as we said, you don't know what you don't know. And unfortunately, I think sometimes people will, they'll catch a snippet of something and they'll automatically put it on the blacklist as, I can't understand that, it's too complex, or great Aunt Sally, she did that and didn't work out for her. People have a lot of reasons that they don't continue down the rabbit hole to thoroughly investigate it. And this is definitely something that people need to venture down and really understand before dismissing it as a strategy for their lives.
Yeah, and that's something that David and I really caution people with infinite banking is make sure that this is not saying that I don't think people do this with malice, but there are a lot of, people out there that say, "Oh, I'm familiar with that," or "I kind of know," and I kind of don't, but they are not specialists in that area. And there's actually multiple people we've come across that have heard of infinite banking and they have a negative experience, or they read a book on it, or like you said, Great Aunt Sally did it, but it wasn't done correctly. This is, and David said this earlier, it has to be specially designed with the right company, specially designed for the right person, specially designed with the right structure internally. This isn't something that we can, go down to 7-Eleven on the corner and get, an IBC account and a Slurpee. That's not how this works. They're not on every corner. This has to be done correctly. And I always use the concept of like, you want to go to a specialist who's going to do the job right. So if you have a foot problem, don't go see a cardiologist. That doesn't make any sense, right? And it's not saying that we are, I guess, not trying to poo-poo other companies or other people, but we just want to make sure people who are looking into infinite banking, please make sure it's done correctly and with somebody who truly understands it and is able to design it correctly based on you and your situation, because everybody's different, their goals are different, and you want to make sure that we outline that. And then the last thing I'll say is a lot of people will kind of blacklist it and they're kind of more familiar with the traditional route of putting it into a self-directed IRA, right? And really, when we look at most people in the real estate world and we're having conversations with clients, they talk about a lot of the issues they have with the self-directed IRAs. And I always say the R and IRA stands for restriction, right? You can only make so much money. You are subject to UBIT taxation. And oh yeah, you can't use your money for this, but you can use it for that. And you can only put so much in a year and, right? And it's one of those things where it's not that self-directed IRAs are bad. They are a stepping stone in growing into whatever it is that you're trying to accomplish. But if we can use something that's more efficient and effective in growing our wealth, not just trying to, throw money on the side and, David said it earlier, hope and pray it all works out. That's not really a strategy. Self-directed IRAs, they have some value there, and we a lot of IBC accounts do partner well with them, but we just want to make sure that, if we really look at the problems out there, what tool is actually going to most efficiently and effectively address them and get them fixed.
Yeah, that's a good point. And I'll end on this too, kind of a follow up of what Erica said. You got to be careful because a lot of people out there schlepping product that have what I call commission breath, right, are mostly just, they're salespeople and they know of this strategy, but they don't design it efficiently. And it's really just left a bad taste in a lot of people's mouths. So when you're looking at the strategy, don't go to a salesman, go to a wealth strategist. And also one that actually knows real estate, right? That if you're doing real estate, because there are people that do the IBC, the infinite banking concept, but they don't do real estate. They might sell a REIT, right, or something like that, and they don't really know of the ways to put it to use. So Eric and I, we are wealth strategists. We're diverse in real estate, and we're not just transactional where it's a one and done. We're going to help it get set up properly, educate on using it efficiently, and help to continually understand and use this and make decisions that correlate with what they're trying to accomplish in real estate.
Yeah, that's a significant reason of why I was actually, messaging you guys and like, hey, I'd really love to put you on this podcast because you can sniff out, like you can sniff out the salesy people, and you can also tell people who are sincerely investing in this and investing in people and actually care about people. They'll take the time to talk about it. They'll take you. And you guys are that way. I mean, it's clear as we're standing around that table just hanging out talking about this, it's clear that you're passionate about this, that you know what you're doing, and that you put your clients' needs first, which those are the kind of people that we like to do business with.
We just
thank you for that.
Yeah, thank you for that. We love the impact that we can have on people's lives, right? Not just transactional mindset. It's help people grow because we're growing alongside them as well, too, right?
It is.
We're all on
And
the same mission, and that's
David and I, our background is both of us have come from the traditional financial planning world, right? Where people just, we're like, just again, we used to be in the position of shopping product because we didn't know any better, right? We went and worked for a big, large, financial corporation, and then he worked for one, I worked for a different one, and I found out very quickly when you work for company ABC, they're going to tell you to sell product ABC.
Yes.
Right. And I will tell you what, 9 times out of 10, if somebody tells me what company they work with, I can tell you what product you're in because it is not based on the client. It's not based on their needs. It's based on whatever product that company sells. And so David and I mean, in our experience, we just started seeing what was going on in the financial world and, how it wasn't for the client, it was for the company and all of that. So anyway, that's where, our branch, our firm, our practice, all of that is solidified on, no, we are here to help people. They need help. We've needed help. So we just want to just create this empire of people, right? Where we all work and grow. And David, you said this perfectly. Like we all just want to scale together. And I just have this vision of like being, 65 years old and, sipping pina coladas on the beach with like all these other people. And we've just been doing real estate and IBC together for like 40 years. And we're going to look back on all of the cool things that we've done. And that's just kind of my, corny future into the future kind of look, but it's exciting.
I love it. I'll be there on the beach with you. Absolutely. We'll do that for sure. And we'll do it along the way too, because we're going to have all of our wealth strategies in place so that we can enjoy along the way. But I'm
absolutely.
curious, you guys had a story of success, somebody who went through a rough time and utilized. I won't tell your story. It's your story.
So yeah, so I've got a specific situation, with alongside of just being able to get people excited about additional wealth strategies that help them scale. Because commercial real estate's a scaling investment, so is the infinite banking. So we've really had a lot of people. I've had people come to me and say, "Man, this is exciting. That's all I can think about is the real estate and infinite banking and how to correlate this." So along with that, we got to think of this as an action and a legacy play, right? That has something to leave behind. And so one of my stories is of just an impact on somebody is I met with a client who, was 3 years away from retiring. He was 62. He worked for Lockheed all of his life. He had a great pension. He had a military pension. Everything was in place. They came to me as just wanting to open up a Roth account. And I said, well, let me look and see how a Roth account would fit into all of your picture, to your picture, right? Because I don't want to just give you a transactional product. I want to make sure that it's the right fit for you and there's a purpose for it. So in long story short, and just looking at their overall situation, putting another, $6,000 into a Roth did not really equate because of just their time frame. It didn't equate to much, and if anything, another $1,000 a month of retirement income. Well, they were sitting with 6 figures plus of retirement income with his military and Lockheed. The one glaring issue was that RJ was his name and the wife was Karen. RJ was 10 years older than Karen. So he was 62, she was 52.
Oh, wow.
Okay. Most of his military and Lockheed pension, if he passed away, it was going to be gone. So that's not if, but when he passed away, she was going to lose 75% of the income. It was going to be a huge hit. And he's 62. So what are you going to do? You're going to get a term policy and most likely outlive it. So I talked to them about the value of permanent insurance, permanent cash value insurance, right? To have a savings vehicle and also have this permanent death benefit. Well, at 62, his mindset was always buy term and invest the difference. So he didn't quite understand it. So he kind of fought a little bit on it, but went and thought about it for a little bit, decided that this was a right play because the death benefit, when he passed, and right, I was praying for RJ, they lived long and healthy life. But when he passed, it's not if, but when he passed, Karen would now have a tax-free death benefit to come into play to replace that income, whatever stage. So he decided this was a right path, right choice to protect her, to divert some money into this instead of the Roth account since they were set up. Well, they made a decision to do it. They signed the paperwork. 2 weeks later, Karen calls me basically saying she's really worried because RJ was having some vision issues and went to go get an MRI. Come to find out he had stage 4 cancer. He had a mass in his brain, had stage 4 cancer, and then he basically passed away a year and a half later. He passed away, or actually, no, I'm sorry, it was less than a year. Less than a year later, he ended up passing away. So it was a sad situation. We miss RJ. But the decision that he made, Karen, because he didn't get to, not only did he lose income, he didn't get to finish out his retirement. So she took a huge cut on the retirement.
Wow.
So because he made that decision, right? Karen, now she will always, she'll trade all that for RJ back, right? But the financial decision that he made to incorporate this asset now basically set her for life. She's taken care of now income wise for life. So, we cried together. I just, even though crying with her about the loss of RJ, just being able to hand her that tax-free death benefit and just tell her, look, RJ is smiling in his grave because he made the right decision to take care of you long-term, right? So when we look at it as a legacy play, there's a lot more things that people don't want to focus on death benefit. They want to focus on living benefits, which there is a lot of, right? But death benefit also in that legacy and leaving behind something to protect family, to protect the ones that you love is very, very important as well.
It's, I can actually speak to that really plainly because my dad was perfectly healthy, actually. Had just gone through and had a bunch of health work done, and at age 69 dropped dead. And having all of these things in place is imperative, because when someone passes away, and it doesn't matter, because like we've seen people, we've lost people through the long battle of cancer, and we've experienced like my true north just gone like that instantly. And if you don't have these things set up ahead of time, it would really, the complications that can arise from that in an already stressful emotional time. So people don't, like you said, most people don't want to talk about the death part. They just want, okay, well, I'm going to use this as my investment here. But I love that you guys look at, it really is like full service, for lack of a better term, but it's taking care of every facet of people's life, from start to finish.
Absolutely. Yeah. And I know we're going to cut off on time, but I just wanted to bring out one more book in case, people are looking for just more things to feed your brain. There's a book called What Would the Rockefellers Do? So it's fantastic, because if we want what everybody else has, go do what everybody else is doing. But if we want to replicate what people like, Warren Buffett and the Rockefellers and all of these incredible, people who are known for their wealth building, if we want to recreate what they're doing, this book actually compares the Rockefeller family to the Vanderbilt family and how they were both massive titans in the beginning. And it really just compares the way that they pass along generational wealth from, years and years and years, and how the Vanderbilts now, they don't have much left to their name other than the school in Tennessee, right? And then the Rockefellers are still out there killing it. And so there is an aspect to passing along generational wealth in the most tax efficient way. We don't know what inheritance tax or, estate taxes or anything else is going to be done in the future. But if you just, if you, like you said, do this in advance, you don't have to worry about it. It's a one and done. It's a very simple process. I think everybody can relate to an instance in their life where somebody passed away unexpectedly, or it wasn't planned, or they're having to go through estate and attorneys and everything else, and family starts fighting. It's a mess. I don't want my family to remember me in having to go through a mess. I want it to be simple and easy. So that's a great book if you're looking for something to read.
Awesome. You guys, thanks so much. We totally went way over what I expected. I'm so sorry, but you guys are so awesome, and I really appreciate your time. I appreciate your professionalism and your willingness to help educate people. And in the league, we'll have all sorts of links and everything. So, a lot of people put that here, but, it's hard to sit there. It's easier to, write everything down. So I like to just drop hyperlinks in to make it just click ready, for everybody. So all that will be there.
Thank you for having us. We really appreciate it, and we'd love to do more of these with you as well.
Awesome. All right.
Thanks, Julie.
Well, enjoy your weekend.
Yes, you too.
Thanks so much for joining me for another episode of Ask Me How I Know. My guests are the most humble successes, so be sure to show them your appreciation by rating this episode 5 stars, which sounds silly, but let's be real. Ratings, likes, and shares, they take no time at all, but make all the difference in the world, if only to boost morale. Also, since I don't spend time on the how and why they got into investing, be sure to check out the show notes to get to know more about today's guests, including other podcasts they've been on that has a more traditional format that will give other details about their investment journey. It'll also tell you things like the most influential person in their life and what they're reading right now, as well as how to connect with them. And please, subscribe and rate Ask Me How I Know so it reaches other listeners like you. Until next time, go find your freedom.